It all started with a dream, the dream of homeownership. For years, banks in the United States had been making it easier and easier for people to buy homes. Traditionally, getting a mortgage required a solid credit score, a steady income, and a down payment. But in the early 2000s, that changed. Banks and lenders started approving mortgages for people who wouldn't have qualified before, even those with bad credit or unstable incomes. These risky loans became known as subprime mortgages. Why were banks doing this? Because housing prices had been rising for years, and everyone assumed they would keep going up. That meant even if a borrower couldn't make payments, the bank could just seize the house and sell it for a profit. It seemed like a win-win, but there was more to it. Banks didn't just keep these risky loans on their books. They bundled them together into mortgage-backed securities, MBS. These were then sold to investors, including hedge funds, pension funds, and even foreign governments. Since these investments were tied to real estate, they were considered safe. Ratings agencies like Moody's and Standard & Poor's gave them high ratings, sometimes even AAA, the safest possible rating. But hidden inside these investments were thousands of bad loans. Loans given to people who, realistically, might not be able to pay them back. And as long as home prices kept rising, nobody noticed. Then, in 2007, cracks began to appear. Housing prices stopped rising and started to fall. People who had taken out risky mortgages, often with adjustable interest rates, saw their monthly payments skyrocket. Many couldn't afford to pay. Foreclosures surged, meaning banks were repossessing homes, but now those homes were worth far less than the loan amount. Investors who had bought mortgage-backed securities suddenly realized they weren't holding safe assets. They were holding toxic debt. The banks, hedge funds, and financial institutions that had bet everything on these investments started losing billions. Panic set in. Some of the biggest names in finance were on the brink of collapse. Lehman Brothers, a massive investment bank, filed for bankruptcy in September 2008, the largest in U.S. history. Another giant, Bear Stearns, was sold at a fire sale price. AIG, a major insurance company that had insured many of these toxic assets, was about to collapse as well. The entire financial system was on the edge of ruin. Banks stopped lending to each other out of fear that more institutions would fail. This credit freeze spread beyond Wall Street to Main Street. Businesses struggled to get loans, people lost their jobs, and the stock market crashed, wiping out trillions of dollars in wealth. The U.S. government had to step in. The Troubled Asset Relief Program, TARP, was launched, injecting billions of dollars into banks to stabilize the system. The Federal Reserve slashed interest rates to near zero. Over time, these efforts helped stop the bleeding, but the damage was done. Millions of people lost their homes, their jobs, and their savings. The 2007 to 2008 financial crisis was a harsh lesson in what happens when greed, risky bets, and a lack of oversight collide. It reshaped the financial industry, led to new regulations like the Dodd-Frank Act, and left a lasting impact on the global economy.